Before we begin, please remember that I am not a licensed financial advisor, and this video is for educational and informational purposes only. The information presented here is not financial, legal, or tax advice. You should always consult with a qualified professional before making any decisions about your financial future. This presentation is based on the insurance landscape in the United States, and your individual situation is unique. Imagine you're 32 years old. You just closed on your first house, the one with the big backyard you always dreamed of for the kids. You have a 3-year-old who leaves a trail of toys everywhere, and a mortgage that feels like Mount Everest. Life is chaotic, it's expensive, but it's yours. It's perfect. Now imagine your spouse gets a phone call that shatters that perfect life into a million pieces. You're gone. An accident, a sudden illness, it doesn't matter how. The only thing that matters is that you're not coming home. What happens the next day? What happens to that mortgage? Who pays for daycare, groceries, the car payment? Does your family get to stay in that house, in that neighborhood with the good schools? Or does a personal tragedy immediately become a financial catastrophe? This isn't a scare tactic. This is the single most important question you can ask yourself if you have people who depend on you. And the fact that most people can't answer it is a terrifying problem. But what if you could build a financial fortress around your family? A shield that guarantees no matter what happens to you, their lives can continue. The mortgage gets paid. The lights stay on. The college funds keep growing. That is not a fantasy. It's the promise of life insurance. And today we are going to demystify the single most powerful and affordable tool for young families, the 30-year term life insurance policy. By the end of this video, you will not just understand what this is. You will know with absolute clarity if it's the right move for you. You will understand how it works in plain English, why the 30-year part is so critical, and how to think about it not as an expense, but as the up. You hear things like whole life, universal life, variable. It's a guarantee that if you're not there to make those payments for the next 30 years, the house is safe, the debt is cleared, your family doesn't lose their home. But it's bigger than just the mortgage. Let's go back to our 32-year-old couple. They have a toddler. If they have another child soon, they're looking at roughly 20 to 25 years of raising kids, of paying for food, clothes, braces, summer camp, and eventually college. The cost of raising a child to age 18 in the US is now well over $250,000. And that doesn't even include a university education. A 30-year term policy acts as a backstop for all of those expenses. It ensures your dream of sending your kids to college doesn't die with you. It ensures your spouse isn't forced to work 3 jobs just to keep things afloat. And there's a third critical component, your retirement savings. Over those 30 years, from your early 30s to your early 60s, you and your partner are in your peak earning and saving years. This is the crucial window where you build the nest egg you'll live on in your golden years. If one of those incomes suddenly vanishes, what happens to the retirement plan? It gets derailed or completely destroyed. The surviving spouse is often forced to dip into their 401k or other retirement accounts just to pay the monthly bills. A 30-year term policy protects that future. The death benefit can replace your lost income, allowing your partner to continue saving for a retirement you both planned for. So when you put it all together, the 30-year term isn't some random number. It's a strategic financial tool designed to create a bridge. It bridges you from the point of maximum financial vulnerability, young kids and new mortgage, little savings, to the point of financial independence where you're in your 60s, the kids are grown, the house is paid off, and you have a substantial nest egg. At that point, you've become self-insured. You don't need the life insurance anymore because your assets can provide for your surviving spouse. The 30-year term has done its job perfectly, protected you when you needed it most. This is the fundamental concept. It's not about dying. It's about a plan for living. It's about removing the biggest what if from your family's life. It's about transforming anxiety into security. It's about knowing that the life you are building today is protected for the next 3 decades, come what may. You're essentially creating your own private miracle for your family. A financial rescue that arrives at the exact moment they would need it most. So let's talk about what that rescue mission actually looks like, and more importantly, who it's for. Because a 30-year term policy isn't for everyone, but for a specific group of people at a specific time in their lives, it is the single most powerful financial tool they will ever own. Is it for you? Well, let's see. Picture a young couple, we'll call them Mike and Jessica. They're 29 and 30. After years of saving, they just did the big thing. They bought their first house. You know the feeling. The smell of new paint, the echo in the empty rooms, the thrill and sheer terror of signing that mountain of paperwork for a 30-year mortgage. This house isn't just wood and drywall. It's a vessel for their future. It's where they imagine their kids taking their first steps, where they'll host Thanksgiving dinners, where they'll grow old together. Their dream is built, quite literally, on the foundation of 2 incomes. Now let's ask the uncomfortable question. What happens if Mike gets in a car accident on his way home from work and doesn't make it? Suddenly Jessica is alone, grieving, shattered, and staring at a 30-year mortgage payment that was designed for 2 people. Without life insurance, her reality shifts in an instant. The dream home becomes an anchor, a monthly financial crisis. The question is no longer what color should we paint the nursery, but how quickly can I sell the house before the bank forecloses? That house, the symbol of their future, becomes a casualty of the tragedy. But let's rewind. Imagine Mike and Jessica had the foresight to put a 30-year term life insurance policy in place when they signed for the mortgage. The cost? Probably less than their weekly coffee budget. Now the unthinkable happens. It's still a devastating tragedy, but financially it's a different world. Within a few weeks, a check arrives for Jessica. A check large enough to pay off the entire mortgage. Instantly, the biggest financial burden in her life is just gone. The house is hers, free and clear. It's no longer a source of panic, but a sanctuary. A place of stability for her to grieve and rebuild. A place where the memories of Mike are safe. That is the power of aligning your term length with your biggest debt. For Mike and Jessica, the 30-year term wasn't just a policy. It was a fortress built around their dream. Now let's add another layer. A year after buying the house, Mike and Jessica have a baby girl, Chloe. And if you're a parent, you know that the moment you hold your child for the first time, your entire concept of risk changes. You are no longer just protecting a dream or a house. You are protecting a life. A tiny, helpless human who depends on you for everything. Food, shelter, love, and opportunity. The financial weight of that responsibility is immense. We're talking about the cost of raising a child to adulthood. It's not just diapers and formula. It's daycare, which can cost as much as a mortgage payment. It's braces, summer camps, soccer leagues, piano lessons. It's their first car. And of course the big one, college. The Department of Agriculture estimates it costs over $300,000 to raise a child to age 18. And that doesn't even include the astronomical cost of college. So let's go back to our scenario. If Mike passes away when Chloe is just 1 year old, Jessica isn't just facing a mortgage. She's facing 17 more years of raising a child on a single income. How does she save for college when she's struggling to pay for groceries? How does she afford after-school activities? Does she have to take a second job, missing out on being there for Chloe? This is where the 30-year term policy becomes a financial guardian. That same policy that paid off the house also provides a massive lump sum of cash. This money doesn't just replace Mike's income for a year or 2. It replaces it for decades. It ensures Chloe's life doesn't have to be downsized along with her family. It means Jessica can afford the daycare she needs to keep her job. It means the college fund continues to grow. It means Chloe can still play soccer, take those piano lessons, and have the future her parents dreamed of for her. The 30-year timeline is critical here. It acts as a bridge, spanning the entire length of Chloe's childhood and dependency, carrying her safely across to adulthood, ensuring she has every opportunity, even if one of her parents isn't there to provide it. So, who is a 30-year term for? It's for new homeowners. It's for new parents. It's for anyone with young children. It's for anyone who has a financial obligation, a debt, a dependent, that will last for the next few decades. It's for anyone whose premature death would cause a financial catastrophe for the people they love most. It's a solution specifically engineered for the most financially vulnerable and most important phase of your life, the building phase. Now I can hear the question some of you are thinking. It's the big logical objection. Okay, this sounds great, but what if I live past the 30 years? I pay all this money for 3 decades and get nothing back at the end. Isn't that a complete waste of money? And that is a fantastic question, but it's based on a misunderstanding of what insurance is for. Let me reframe it for you. Do you buy car insurance hoping you'll get in a fiery wreck so you can cash in on the policy? Of course not. You buy it for protection in case something terrible happens. You pay your homeowner's insurance premium every year. Are you disappointed when your house doesn't burn down? No, you're relieved. Outliving your 30-year term life insurance policy is not a waste. It is the absolute best-case scenario. It is the goal. It means you won. It means you lived a long, healthy life. It means you saw your children grow up, graduate, and start families of their own. It means you paid off that 30-year mortgage and you're burning the paperwork at a backyard barbecue. It means the policy did its job perfectly. It stood guard silently for 3 decades, protecting your family during their most vulnerable period. Think of it like a life raft you carry on a long ocean voyage. For the first 30 miles, the waters are notoriously treacherous and unpredictable. You absolutely need that raft. But after that, you reach a safe harbor. A calm, protected bay where you'll spend the rest of your journey. Do you get to the safe harbor and say, "Man, I'm so mad I dragged that raft along and never had to use it"? No. You're just grateful you made it safely. The premiums you pay are the cost of guaranteeing your family reaches that safe harbor, whether you're at the helm or not. By the time the 30 years are up, the goal is that you no longer need the insurance. Your kids are financially independent. Your house is paid off. You've had 30 years to build savings, investments, and retirement accounts. You have become self-insured. The policy was the scaffolding that allowed you to build your financial house. Once the house is built, you can take the scaffolding away. It served its exact intended purpose. So we've established the why. We've identified the who. It's for the builders, the protectors, the young families laying the foundation for the rest of their lives. But that leads us to the most critical question of all, the one that stops most people in their tracks. How much? How much coverage do you actually need? Is it 500,000? A million? 2 million? People either guess and pick a random round number, or they get overwhelmed and do nothing at all. And both of those mistakes can be devastating. Getting it wrong could mean you overpay for decades, or far worse, leave your family with a fraction of what they truly need to survive. There is a simple, straightforward way to calculate your perfect number, and in the next part we are going to break it down step by step so you can figure out your exact number with confidence. So what is that magic number? How much life insurance do you actually need? Forget the confusing jargon from financial gurus and the overly simplistic online calculators that spit out a random number without any context. There's a simple 4-letter framework that cuts through all the noise. It's an acronym, DME. That's DME. Debt, income, mortgage, and education. By calculating these 4 things, you're not just picking a number out of thin air. You're building a customized financial fortress for your family. Let's build one right now. Let's imagine a hypothetical person. We'll call him Mark. Mark is 35 years old, married with 2 young kids, ages 3 and 5. He's the primary breadwinner. His situation is probably a lot like yours or someone you know. We're going to walk through his life and calculate his number, and you can follow along, plugging in your own numbers as we go. First up is D for debt. This is the first and easiest step. The goal here is to wipe the slate clean for your family. We're talking about any non-mortgage debt. Think about it: credit card balances, car loans, student loans, any personal loans you might have. If you were to pass away tomorrow, these debts don't just vanish. They become a burden on your estate and a source of incredible stress for your grieving spouse. The first promise of a good life insurance plan is to eliminate that stress instantly. So for Mark, let's say he has a $15,000 remaining balance on his car loan, and he still has $25,000 in student loans from his college days. Pretty common. We add those together. $15,000 plus $25,000 equals $40,000. That's his number for D. Write that down. For you, take a minute to think. What do you owe on your cars? Your credit cards? Your student loans? Add it all up. That's your D. Next, and this is the big one, is I for income. This is the absolute core of your life insurance calculation. The question you're answering here is, how much of my income does my family need, and for how long to maintain their standard of living? A common rule of thumb you'll hear is 10 times your annual income. It's not a bad starting point, but it lacks precision. Let's be more intentional. Think about how many years your family will need financial support. For Mark, his youngest child is 3. He wants to make sure his family is supported until that child is at least through college, say age 22. That's a 19-year gap. Let's round it up to 20 years to be safe. Mark earns $80,000 a year. So, we take his income, $80,000, and multiply it by the number of years his family needs it, which is 20. 80,000 times 20 is $1,600,000. A huge number, right? But this isn't for a lavish lifestyle. This is to cover 2 decades of groceries, utility bills, health insurance premiums, car repairs, clothes for the kids, and everything else that his paycheck currently covers. It's about creating continuity and stability during the most difficult time imaginable. For you, think about your own situation. How old are your kids? How many years until they're financially independent? Or maybe your goal is to support your spouse until they reach retirement age. Pick that number of years and multiply it by your current annual income. That's your I. The third letter is M for mortgage. For the vast majority of American families, the mortgage is their single largest debt and their biggest monthly expense. Imagine the psychological and financial relief for your family if, in the midst of their grief, they learned that their home was completely 100% paid for. They would never have to worry about making another mortgage payment. They would never have to worry about being forced to sell their home, to uproot their kids from their school, their friends, and the life they've always known. Paying off the mortgage provides an anchor of stability when the entire world feels like it's adrift. This one is simple to calculate. You just need to know your outstanding mortgage balance. Mark and his wife bought their home a few years ago, and they currently owe $300,000 on their mortgage. So Mark's M is $300,000. For you, just look at your latest mortgage statement. What's the principal balance remaining? That's your M. Finally, we have E for education. This is about legacy. This is about ensuring that your dreams for your children's future don't die with you. For many parents, one of those core dreams is providing them with the opportunity to go to college without being saddled with crippling debt. The cost of college is skyrocketing, and it's a source of anxiety for parents everywhere. Life insurance can be the ultimate college savings plan, guaranteeing the funds are there no matter what. Mark has 2 kids. He wants to set aside enough money for both of them to attend a good state university. Today, the average cost for 4 years at a public university, including tuition, fees, room, and board, can easily top $100,000. And that cost is only going up. To be safe and account for inflation, a good target is to set aside around $150,000 per child. Since Mark has 2 children, he'll need twice that. $150,000 times 2 is $300,000. That's his number for E. For you, think about your own kids. How many do you have? What are your aspirations for their education? A public university? A private one? A trade school? Estimate a future cost and multiply it by the number of children you have. That's your E. Now we put it all together. We add up Mark's DIM and E. His debt was $40,000. His income replacement was $1,600,000. His mortgage was $300,000. And his education fund was $300,000. When we add all of that up, $40,000 plus $1.6 million plus $300,000 plus another $300,000, we get a grand total of $2,240,000. $2.24 million. That might feel like an impossibly large number. Sounds like a lottery win. But when you break it down using the DIME method, you see that it's not a luxury number. Every single dollar is assigned a critical job. It's paying off a debt, replacing a paycheck, securing a home, or funding a future. It is a lifeline, not a luxury. But we're not quite done. There's one final crucial step. We need to subtract any existing assets you already have that could be used for these goals. Most people aren't starting from absolute zero. You might have some existing life insurance through your employer. You might have savings, a 401k, or other investments. We can subtract these from our total, so we're not overinsuring and overpaying. Let's go back to Mark. He has a life insurance policy through his job. It's a common benefit, but it's usually pretty small, typically just 1 or 2 times your annual salary. Mark's policy is for $80,000. He also has been a diligent saver and has about $60,000 in a savings and brokerage account that isn't earmarked for retirement. So we can subtract both of these from his total need. $80,000 plus $60,000 is $140,000 in existing assets. So we take his grand total $2,240,000 and we subtract his assets of $140,000. His final true life insurance need is $2,100,000. That is his number. That is the face value of the 30-year term policy he should be looking for. It's a number grounded in reality, built to protect his specific family's needs for the long term. Now it's your turn. You've calculated your D, your I, your M, and your E. You've added them all up. And you've subtracted your existing savings and insurance. You should be looking at a number on a piece of paper right now. It might be $1 million. It might be $2 million. It might be more. And you're probably thinking the exact same thing I was when I first did this calculation. There is no way on earth I can afford that. feels completely out of reach. But what if I told you that for most healthy people in their 30s, securing $1 million policy costs less than their monthly Netflix and Spotify subscriptions combined? What if I told you that peace of mind is radically cheaper than you think? In the next part, we're going to pull back the curtain on the real cost of 30-year term life insurance. We're going to look at actual price charts, and the numbers are going to absolutely shock you. Alright, let's rip the band-aid off. There's a massive industry-wide secret about life insurance, and it's this: you are almost certainly convinced it costs way more than it actually does. I'm not talking a little more. I'm talking about a Grand Canyon-sized gap between perception and reality. A study by the industry groups LIMRA and Life Happens found that most people overestimate the cost of term life insurance by more than 3 times. Millennials, my generation, are even further off. They overestimate the cost by more than 5 times. 500%. Imagine going to buy a $20 t-shirt, but you have $100 in your hand because that's what you thought it would cost. That's the level of disconnect we're dealing with. So when I say the numbers are going to shock you, it's because the real price tag feels like a glitch in the matrix compared to the phantom price living in our heads. So what actually determines that price? How does an insurance company look at you, a unique human being, and boil you down to a monthly premium? It's less complicated than you think. They're basically professional risk assessors, and they're looking at a handful of key factors. Think of it like a pricing recipe. The first and biggest ingredient is your age. This one's just simple math. The younger you are when you apply, the more years of life you statistically have ahead of you, and therefore the lower the risk you are to the insurance company. Getting a 30-year term policy at age 30 means they're betting you'll live past 60. Getting that same policy at age 45 means they're betting you'll live past 75. The first bet is just a safer one for them to make, so they give you a better price. The second ingredient is your health. This is where the medical exam we talked about comes in. They want to know your height, your weight, your blood pressure, your cholesterol. Do you have any pre-existing conditions like diabetes or heart disease? They'll look at your family's medical history too. They're essentially trying to build a health profile to predict your long-term wellness. They group people into health classes, often with names like Preferred Plus, Preferred, Standard Plus, and Standard. The better your health class, the lower your premium. It's like getting a good driver discount on your car insurance, but for your body. The third ingredient is your gender. Statistically, women in the United States live on average about 5 to 7 years longer than men. Because of that longer life expectancy, women generally pay less for life insurance than men of the same age and health. It's not about fairness in the social sense. It's about actuarial data on a massive scale. Fourth, your lifestyle. The big one here is tobacco use. Are you a smoker? A vapor? If so, your rates will be significantly higher, often 2 to 3 times higher than a non-smoker's. They might also ask about risky hobbies like skydiving or scuba diving, or your driving record. And the final ingredient is the policy itself. How much coverage do you want? That's the death benefit, and for how long? In our case, the how long is locked in at 30 years. So the main lever you control here is the coverage amount. A $1 million policy will, of course, cost more than a $500,000 policy. So age, health, gender, lifestyle, and coverage amount. That's the recipe. Now let's stop talking in hypotheticals. Let's cook something up and see the actual prices. Let's start with a very common scenario. Meet David. David is 30 years old. He's in excellent health, a non-smoker, healthy weight, great blood pressure. He qualifies for the best health rating, Preferred Plus. David wants a 30-year term policy with a $500,000 death benefit. Enough to replace his income for a number of years, pay off the mortgage, and fund his kid's college education if something happens to him. He gets his quotes. What do you think he's going to pay per month for $500,000 of protection for the next 30 years? $100 a month? $150? David's monthly premium is about $28. Let that sink in. $28 a month. That's less than most people spend on streaming services. It's the cost of a few fancy coffees. For $28, David has guaranteed that for the next 3 decades, through promotions, new homes, and watching his kids grow up, his family is protected with $500,000. Now let's look at Sarah. Sarah is also 30 years old, in identical excellent health, also a non-smoker. She wants the same $500,000, 30-year term policy. Remember what we said about gender and life expectancy. Sarah's monthly premium is about $24. For dollars less per month than David's, simply because on average women live longer. Okay, but what if $500,000 isn't enough? Let's go back to David. He reevaluates and decides he wants to double the protection. He wants a $1 million policy. Same guy, same health, same 30-year term. What's the price now? You'd think if you double the coverage, you double the price, right? So around $56? It's actually even better than that. For a $1 million policy, David is looking at around $45 a month. $45 for $1 million safety net. It's staggering how affordable that peace of mind can be. Now let's change the age ingredient and see what happens. Let's imagine David waited 10 years. He's now 40 years old, still in excellent health, still a non-smoker. He wants that same $1 million 30-year policy. Because he's a decade older, the risk for the insurance company has gone up. His new monthly premium isn't $45 anymore. It's closer to $75 a month. Still incredibly affordable for what you're getting, but it's a nearly 70% increase just for waiting 10 years. The price of procrastination is real, and it is steep. But the most dramatic price jump comes from that one lifestyle choice: smoking. Let's rewind to 30-year-old David. We know his $1 million policy costs about $45 a month as a non-smoker. Now let's imagine an alternate reality where David is a smoker. Same age, same general health otherwise. What's his premium now? That $45 premium skyrockets to around $140 a month. That's more than 3 times the price. Over the 30-year term, smoker David will pay over $34,000 more than non-smoker David for the exact same $1 million policy. It is, without a doubt, the single most expensive financial penalty associated with smoking that most people never even consider. So when you see these numbers, you start to understand why that initial statistic exists, why everyone thinks this is so expensive. We're bombarded with ads for other types of insurance. Car insurance can be hundreds of dollars a month. Health insurance can be thousands. We're conditioned to see the word insurance and mentally attach a hefty price tag to it. But term life insurance operates on a different principle. The insurance company is betting on a statistical certainty. Most people who buy a 30-year term policy will outlive it. They're not expecting to pay out on every single policy. They're managing a massive pool of risk, where the premiums from the millions of people who live are used to pay the claims for the few who tragically don't. Your youth and your health are your single greatest assets in this equation. They are the currency you use to buy the lowest possible price. And it's a currency that you spend a little bit of every single day. You've seen how affordable it is if you act now. You've seen how waiting 10 years can increase the cost by nearly 70%. But that's just a snapshot. What happens if you wait just 1 year? Or 5? What is the real dollar-for-dollar penalty you pay for every single birthday you let pass without getting covered? The price you just saw. It's a limited time offer. A discount code given to you by your own youth. And once it expires, it's gone forever. In the next part, we're going to break down the true cost of waiting year by year and show you exactly how much money you are lighting on fire by putting this off until later. Let's start with a simple number: $21,600. That's the price of a brand new respectable car. It's a down payment on a house in many parts of the country. It's a life-changing amount of money for most families. It is also, for many people, the completely unnecessary price they will pay for one of the most common financial mistakes in the world: procrastination. That is the amount of money you could be lighting on fire. To understand how, let's imagine 2 people. We'll call them Alex and Ben. They are identical in every way. Both are 30 years old. Both are in good health, non-smokers with a young family they adore. Both decide they need a 30-year term life insurance policy for $500,000 to protect their families. This is where their stories split into 2 different realities. Alex decides to act. He goes online, spends about 20 minutes filling out an application, and gets approved. His premium, because he is young and healthy, is locked in at $35 a month. For the next 30 years until he's 60, that rate will never change. It's a fixed expense like his Netflix subscription, but infinitely more important. His total cost for that peace of mind over 3 decades? $12,600. Now let's look at Ben. Ben is just as smart and loves his family just as much. But he tells himself, "I'll get to it later." Life is busy. There's a project at work, the kids have soccer practice, the car needs an oil change. Life insurance feels like a someday task. So he puts it off. A year goes by. Ben is now 31. He finally remembers he needs to get that policy. He's still in great health, nothing has changed. He fills out the same application. But he's not 30 anymore. He's 31. The insurance company's math has changed because he is 1 year closer to his life expectancy. His rate isn't $35 anymore. It's now $39 a month. You might think, for bucks? Who cares? But let's do the math. That's an extra $48 a year. Over the new 30-year term, that's an extra $1,440 that Ben is paying for the exact same $500,000 policy that Alex has. He waited 365 days and paid a penalty of nearly $1,500 for it. He essentially paid $4 every single day for the privilege of procrastinating for 1 year. But Ben's story doesn't stop there. He gets the quote for $39, thinks, it can wait a little longer, and life gets in the way again. Another year passes. He's 32. The premium is now $43. 2 years of waiting has now cost him nearly $3,000 over the life of the policy. At 33, it's $48. At 34, it's $53. Every single birthday that ticks by is like a silent price hike on the most important purchase he will ever make for his family. Then, at age 35, something happens. It's not a catastrophe. It's just life. Ben goes for his annual physical, and his doctor notes his blood pressure is a little elevated. Not dangerously high, just a bit higher than it should be. He's also put on about 15 pounds since he was 30. He's stressed from work, not eating as well as he should. He's a normal 35-year-old American. He finally decides, okay, for real this time, I'm getting this done. He applies for the same $500,000, 30-year term policy. He's now 5 years older than Alex was. He's a little heavier. And he has to check a box on the application that says, yes, to a question about high blood pressure. The insurance company doesn't see him as the super healthy 30-year-old anymore. They see a 35-year-old with a documented health issue. He is now a higher risk. His premium doesn't just jump because of his age. It jumps because of his health. His quote comes back. It's not $50-something. It's $95 a month. Let's pause and look at the two paths. Alex, at age 35, is still paying his locked-in rate of $35 a month. He's 5 years into his policy, and his family is protected. Ben, for the exact same coverage, is now facing a bill of $95 a month. That's $60 more every single month. That's $720 more every year. And over the full 30-year term of his new policy, Ben will pay a total of $34,200. Remember Alex's total cost? $12,600. By waiting just 5 years, by letting life get in the way, Ben will pay an extra $21,600. The price of a new car. The price of procrastination. He is paying a 170% markup for the same product simply because he waited. This isn't an exaggeration. This is the fundamental math of the life insurance industry. The business model is based on risk, and the two biggest factors in your personal risk profile are your age and your health. Every single day you get a little bit older, and every single day, you run the risk of a minor health issue appearing that can permanently change your rates. The discount you get for being young and healthy is the single greatest financial advantage you have. It is a coupon with an expiration date, and that date is tomorrow. Think about what else happens in those 5 years Ben waited. Maybe he and his wife had another child. Maybe they bought a bigger house and took on a bigger mortgage. His family's financial needs actually increased during the very period he was leaving them completely unprotected. The stress of that is a hidden cost too. While Alex slept soundly knowing his family was secure, Ben was rolling the dice every single day, hoping nothing would happen before he got around to it. The cost of waiting isn't just a few dollars a month. It's a cascade of consequences. It's the thousands of dollars in extra premiums. It's the risk of a minor health change making your rates skyrocket. And in the worst-case scenario, it's the risk of developing a major health condition that makes you uninsurable at any price, leaving your family with nothing. People wait because they think they're saving money today by not paying a premium, but what they're actually doing is guaranteeing they will pay far, far more tomorrow. They are trading a small, manageable, locked-in cost for a huge, uncertain, and ever-increasing future expense. It is a terrible trade. The single most important day to buy life insurance was yesterday. The second most important day is today. Because the price you can get right now at this very moment is the lowest price you will ever be offered for the rest of your life. It is a non-renewable resource. So we've seen the staggering financial cost of waiting. But this probably brings up a critical question for many of you. What if you're like Ben at 35? What if you're thinking, I'm not perfectly healthy right now? What if you already have high blood pressure, or you're overweight, or you have a pre-existing condition in your medical history? Does that automatically disqualify you, or make it unaffordable? The answer is almost certainly no, and it's going to surprise you. The truth about the medical exam, how insurance companies look at your health, and how to get the best possible rating even if you're not a super athlete. That's exactly what we're digging into next. So let's pull back the curtain on the life insurance medical exam. When you hear that phrase, what do you picture? A cold, sterile room? A doctor in a white coat grilling you for an hour? Needles, stress tests, running on a treadmill? Forget all of that. For the vast majority of people, the reality is so much simpler it's almost boring. The so-called medical exam is usually a paramedical exam. A licensed medical professional, often a nurse or a phlebotomist, comes to you. To your house, your office, a coffee shop if you want. It's free, it's scheduled on your time, and it typically takes about 20 to 30 minutes. They'll measure your height and weight. They'll take your blood pressure and pulse. They'll ask you to provide a small blood and urine sample. And that's usually it. They'll also go over the questions you already answered on your application, just to confirm everything is accurate. It's less of an exam and more of a verification process. But why do they even do this? It's not because they're trying to find a reason to deny you. It's the opposite. They're trying to find every reason to give you the best possible price. This whole process is called underwriting. Underwriting is just a fancy word for risk assessment. The insurance company is making a multi-decade promise to your family. A promise potentially worth hundreds of thousands or even millions of dollars. In return, they're asking you for a relatively small monthly payment. To make that math work, they need to have a very good idea of their risk. They are in the business of statistics and probability. They're essentially trying to place you into a group with other people who have a similar health and lifestyle profile to predict, on average, the life expectancy of that group. And this is the part that almost nobody talks about, but it is the single most important factor in determining your final price. It's the health rating system. Think of it like a credit score for your health. Just like a high credit score gets you a better interest rate on a loan, a high health rating gets you a lower premium on your life insurance. Every company has its own names for these ratings, but they generally fall into a few key categories. At the very top, you have the absolute best of the best. This is called Preferred Plus or sometimes Super Preferred. This is for the person who is the picture of health. Excellent height and weight ratio, pristine cholesterol and blood pressure numbers, no family history of early heart disease or cancer, and a clean driving record. These people pay the absolute lowest prices. One step down is Preferred. This is still for incredibly healthy people. Maybe your cholesterol is a little bit elevated, or your blood pressure is just a touch high, but still well within a healthy range. Maybe one of your parents had a health issue later in life. You're still getting a fantastic rate, just a small percentage more than the Preferred Plus folks. Next, you have Standard Plus. This is where a large number of healthy Americans fall. You're in good shape, but maybe you're carrying a few extra pounds. Or maybe your cholesterol is managed with a common medication. You're still considered a very good risk, and you're getting a very affordable rate. And then you have Standard. This is the baseline. This is the average healthy person. No major health concerns, but you might be significantly overweight or have well-controlled high blood pressure, or maybe you had a minor health issue in the past. Even at Standard, a 30-year term policy is still incredibly affordable for most people. To put this in perspective, let's imagine a 35-year-old applying for a $500,000 30-year term policy. At a Preferred Plus rating, they might pay around $35 a month. At a Standard rating, that same person for the same policy might pay $60 a month. That difference of $25 a month doesn't sound like a lot, but over 30 years, that's $9,000. Getting a better health rating literally saves you thousands of dollars. Below Standard, there are what's called substandard or table ratings. This is for individuals with more significant health issues like well-managed diabetes, a history of cancer, or a heart condition. The good news is you can still get coverage. The price will be higher, but the protection is still available. So the million-dollar question is, how do you get the best possible rating you qualify for? How do you move up from Standard to Preferred? You can't change your family history, and you can't magically lose 30 pounds overnight. But you absolutely can stack the deck in your favor. And it starts with one simple, non-negotiable rule. Be 100% honest. It is tempting to fudge the numbers, to say you smoke a little less than you do, or to forget to mention that medication you take for your blood pressure. Do not do this. It's called material misrepresentation, and it's a form of insurance fraud. The insurance companies have ways of finding out. They'll pull your prescription history. they'll check your driving record. And they all share information through a service called the MIB, or the Medical Information Bureau. Think of it as a central database for the insurance industry. If you applied for insurance 5 years ago and disclosed a health condition, that information is in the MIB. If you lie on this application and they find out, you'll be denied coverage. And worse, if you pass away and they discover the lie during the claim investigation, they can legally deny the payout to your family. The very people you were trying to protect get nothing. It's the ultimate nightmare scenario. Honesty is always the best and only policy. Okay, with that out of the way, let's talk strategy. Here's how you prepare for your paramedical exam to get the most accurate, and therefore best, results. First, in the 48 hours leading up to the exam, focus on hydration. Drink plenty of water. This makes it easier to draw blood and can help flush your system, leading to better results in your urine sample. During this same window, avoid alcohol completely. It can dehydrate you and temporarily affect your liver enzyme readings. Second, for 24 hours before the exam, avoid heavy, fatty, or excessively salty foods. A giant steak dinner or a greasy pizza the night before can temporarily elevate your cholesterol and triglyceride levels. Stick to something leaner and healthier. Also, avoid strenuous exercise. A hard workout can actually elevate protein levels in your urine and spike your blood pressure, which could send the wrong signal to the underwriter. A light walk is fine, but save the marathon training for after the exam. Third, on the morning of your exam, do not drink coffee or use any nicotine products. Both are stimulants that will raise your blood pressure and heart rate. You want your readings to be as low and relaxed as possible. Most exams are scheduled in the morning because they require you to fast for 8 to 12 hours beforehand, so having that coffee is a no-go anyway. Finally, be prepared. Have a list of your doctor's names, addresses, and phone numbers. Have a list of any medications you take, including the exact dosage. And be ready to discuss your family's medical history, specifically for your parents and siblings. The underwriter will want to know about any instances of cancer, heart disease, or diabetes, and the age at which they were diagnosed. Having this information ready makes the process smooth and shows you're taking it seriously. Now, what if you're listening to this and thinking, my health isn't perfect. I have high cholesterol. I'm overweight. I take medication for anxiety. Please do not despair. You are the norm. Insurance underwriters look at thousands of applications a day. They have seen it all. The key word they are looking for is not perfection. It's management. Is your high blood pressure well controlled with medication? Do you see your doctor regularly for your condition? Are you following their advice? If the answer is yes, you can still qualify for excellent rates, sometimes even preferred rates. A managed condition is a known quantity. An unmanaged, undiagnosed issue is a huge red flag. And here's another insider tip. Different insurance companies view different health conditions differently. Some companies are more lenient on people who are overweight. Others specialize in offering great rates to well-controlled diabetics. Some are more forgiving of a family history of cancer than others. There is no one best company for everyone. It's about finding the best company for you and your specific health profile. Of course, there is one last option, the no exam policy. You've probably seen ads for these. They use data algorithms and database lookups to approve you in minutes without any needles or nurses. And for some people, they can be a good option. But there's always a trade-off. Because the insurance company is taking on more unknown risk by not performing an exam, they almost always charge a higher premium for the convenience. For the vast majority of people, especially those looking for the best price on a 30-year term policy, taking 30 minutes to do a simple exam is the single easiest way to save thousands upon thousands of dollars. So, we've cracked the code on the medical exam and the secret health ratings that drive your price. You now know more than 95% of the people who apply for this stuff. But now it's time to get down to brass tacks. The real numbers. How do you actually shop for a policy? What should you be looking for in a quote? And what are the hidden traps and riders that can completely change the value of your policy? We're going to build your perfect policy piece by piece next. Alright, let's get into the nuts and bolts. Shopping for life insurance can feel like walking into a massive, confusing superstore where everything is locked in a glass case. You know what you need, but you don't know who to ask or what questions are the right ones. We're going to shatter that glass case right now. There are 3 main ways to buy a policy, and the path you choose can drastically change the price and the quality of what you get. Think of it like buying a car. First, you have the captive agent. This is like going directly to a Ford dealership. They only sell Ford products. A captive agent works for one specific insurance company. Think State Farm or Northwestern Mutual. The upside? They know their company's products inside and out. They can be very knowledgeable. The downside? They can only sell you their company's products. If their 30-year term policy is overpriced for someone with your health profile, they can't just pivot and show you a better deal from another carrier. Their toolbox only has one brand of hammer. Second, you have the independent agent or broker. This is like going to a CarMax or a massive multi-brand dealership. They aren't loyal to one company. Their loyalty is supposed to be to you. An independent broker can shop your profile across dozens of different insurance companies to find the one that will give you the absolute best rate. For example, some companies are more lenient with cholesterol levels, while others are more friendly to people with a family history of a specific illness. An independent broker's job is to know these nuances and match you with the company that will view you most favorably. For most people, especially when you're looking for the best price on a simple product like 30-year term, this is the most effective route. Third, you have the direct-to-consumer online platforms. This is the Tesla or Carvana model. You go online, fill out a form, and get quotes spit back at you by an algorithm. This can be fast and convenient. But here's the caution. Sometimes, these platforms are just lead generation machines that sell your information to agents. And often, the initial quote you see online is a super idealized best-case scenario price designed to get you to click. The real price after underwriting can be much different. It's a good way to get a ballpark idea, but it often lacks the human expertise to navigate the complexities. So you've chosen your path. Let's say you're working with an independent broker. They come back to you with 3 quotes. This is the moment of truth. Most people just look at the monthly premium and pick the lowest number. This is a massive mistake. A life insurance quote is not just a price tag. It's a proposal with multiple critical parts. First, look at the health class. You'll see terms like Preferred Plus, Preferred, Standard Plus, or Standard. This is the insurance company's grade for your health and lifestyle. Preferred Plus is the A+ student, the marathon running, kale eating, perfect family history applicant. Standard is a C+ or B-. Maybe you're a little overweight, have slightly high blood pressure, or a less than perfect family history. Each step down in health class means a significant jump up in your premium. The quote you get is based on the health class the agent thinks you can get. Your final price is determined by the health class the underwriter actually gives you after the medical exam. So ask the agent, is this quote realistic for me? Why did you choose this specific health class? Next, look at the company's financial rating. You need this policy to be there for your family in 5, 15, or 29 years. Is the insurance company financially sound enough to pay that claim? You need to check their AM Best rating. It's like a credit score for insurance companies. You want to see a company with an A rating or better, A+, or A++. Don't even consider a company with a B rating, no matter how cheap the premium is. It's not worth the risk. Now we get to the most important part, the part that separates a basic flimsy policy from a rock-solid fortress of protection for your family. We're talking about riders. Riders are add-ons or optional benefits that customize your policy. Some are free, some cost extra, but they can be game changers. Let's build your policy with the essential ones. The first is the Accelerated Death Benefit Rider. This is usually included for free, but you need to make sure it's there. This rider allows you to access a portion of your own death benefit, say 50 to 80%. Asterisk while you are still alive, asterisk if you are diagnosed with a terminal illness and given a short time to live. Think about that. This isn't for your family after you're gone. This is for you. It provides cash to pay for experimental treatments, to get your affairs in order, or to take one last amazing trip with your family. It transforms life insurance from just death insurance into a living benefit. It's a non-negotiable. The second rider to seriously consider is the Waiver of Premium rider. This one usually costs a little extra, but it's your policy's own insurance policy. Here's how it works. If you become totally disabled and can't work, the insurance company will waive your monthly premium payments, but your policy stays in full force. Imagine you're 40 years old, you have $1 million policy, and you get into a terrible accident that leaves you unable to work. The last thing you can afford is a life insurance premium. Without this rider, you might have to let the policy lapse, leaving your family with nothing. With this rider, your payments stop, but your family's protection remains intact. It's disability insurance specifically for your life insurance premium. The third rider is, in my opinion, the single most important feature of any long-term policy. is the conversion privilege or term conversion rider. This is your escape hatch. This is your guarantee for the future. Remember, your 30-year term policy expires. At the end of 30 years, it's gone. You might be 65 years old by then, and your health might not be perfect. Trying to get a new policy at that age could be astronomically expensive, or even impossible if you've developed a serious health condition. The conversion privilege gives you the right to convert your term policy into a permanent policy, like a whole life or universal life policy, without having to prove your health. Let me repeat that. No new medical exam, no new health questions. You could have had a heart attack a year before your term expires, and the insurance company is contractually obligated to give you permanent coverage. You'll pay the rates for a 65-year-old, but you'll get it at a standard health class, even if you're now uninsurable. This rider ensures that you have the option to keep life insurance coverage for the rest of your life, no matter what happens to your health during those 30 years. It is the ultimate future-proofing tool, and you should not buy a 30-year term policy without it. Finally, a quick word on the child rider. This is an inexpensive add-on that provides a small amount of term life insurance, say $10,000 or $20,000, for all of your children under one single low-cost premium. God forbid the unthinkable happens, this rider provides funds to cover final expenses without having to dip into savings. More importantly, most child riders are also convertible. This means when your child becomes an adult, they can convert that small policy into a much larger permanent policy of their own, again with no medical questions. It's a way to guarantee their future insurability, even if they develop a childhood illness. It's a powerful multi-generational planning tool, hidden inside your own policy. So let's recap the perfect policy we've just built. We've shopped the market with an independent broker to find the company that views us most favorably. We've secured a quote that's based on a realistic health class from a company with a stellar AM Best financial rating. And we've customized it. We added the accelerated death benefit so we can access money if we get terminally ill. We added the waiver of premium so our coverage continues even if we become disabled. And most critically, we included the conversion privilege, guaranteeing our right to keep coverage forever, no matter what our health looks like in 30 years. This is no longer just a piece of paper with a death benefit and a price. This is a sophisticated financial instrument designed to protect your family from multiple angles. You've designed the perfect policy on paper. Now comes the real test, getting the insurance company to actually approve it and give you the health rating you deserve. The application, the phone interview, the medical exam, the prescription history check. This is the underwriting gauntlet where applications get delayed, denied, or hit with higher rates. And next, I'm going to give you the insider's playbook for navigating every single step of that process and show you the simple things you can do to ensure you get the best possible outcome. Alright, let's open up the playbook. The entire life insurance application process, from the moment you click submit to the day you get your final approval, is what the industry calls underwriting. Think of it as the insurance company's detective work. Their goal is simple, to figure out how risky you are to insure. Your goal is also simple, to present the most accurate and most favorable version of yourself to get the best possible rate. This isn't about deception, it's about preparation. The game is won or lost before you even start. The process generally has 3 or 4 major stages: the written application, a phone interview, the medical exam, and then the long wait while the underwriter reviews everything. Let's break down each one and show you how to master it. First, the application itself. Whether you're filling this out online or with an agent, this is your first impression. The single most important rule here is radical honesty. I cannot stress this enough. They're not just asking if you smoke. They're asking if you've used any nicotine products, including vape pens, patches, or chewing tobacco in the last 12, 24, or even 36 months. They're not just asking if you have any major health conditions. They're asking about every diagnosis, every prescription, every consultation. You might be tempted to conveniently forget that one-time blood pressure medication you tried for a few months 5 years ago, or that you enjoy a cigar on the golf course twice a year. Don't. They will find out. Insurance companies have access to tools that are incredibly powerful. They can pull your entire prescription history, your driving record, and they share information with each other. If you lie on an application and get a policy, the company can legally refuse to pay the death benefit to your family if they discover the lie later. A concept known as material misrepresentation. The temporary win of a slightly lower premium is not worth the risk of your family getting absolutely nothing. Be honest, be thorough, and if you're working with a good independent agent, tell them everything up front. They know how to frame your history to different carriers, some of whom are more lenient about certain things than others. Next up is the phone interview. A few days after you submit your application, you'll likely get a call from a third-party company hired by the insurer. This will feel like a friendly chat, but it's a verification tool. They will ask you the same questions that were on the application, just phrased a little differently. They're checking for consistency. They'll ask about your health, your family's health history, your job, your income, and your hobbies. If you said on the application you're a desk-bound accountant, but in the phone interview you get excited talking about your weekend skydiving and rock climbing adventures, that's a huge red flag. But here's the secret part of this step they don't advertise. They are cross-referencing your answers with a massive database called the MIB, or Medical Information Bureau. Think of it as a credit report for the life insurance industry. It stores coded information from past insurance applications you've made. So if you applied for insurance 3 years ago and mentioned a sleep apnea diagnosis, but you forget to mention it this time, a flag will pop up on their screen. The key here is the same as before: consistency and honesty. Before this call, review the application you submitted so your answers are fresh in your mind. Now for the main event, the paramedical exam. This is the single biggest point of anxiety for most people, and it's where you have the most control over the outcome. This exam is free to you, and a nurse will typically come to your home or office. They'll measure your height and weight, take your blood pressure and pulse, and collect a blood and urine sample. It sounds straightforward, but small fluctuations in your results can mean the difference between a preferred plus elite health rating and a standard rating. A difference that could cost you thousands of dollars over the life of the policy. So how do you ace this test? Your preparation should start a week out. First, hydrate, hydrate, hydrate. Drink plenty of water all week. This helps flush your system and makes for a much easier blood draw. Second, for at least 3 to 4 days before the exam, cut back on sodium and red meat. High sodium can temporarily spike your blood pressure, and red meat can elevate protein and creatinine levels, which can be indicators of kidney problems. Third, avoid strenuous exercise for at least 24 hours before the exam. A really intense workout can actually elevate your liver enzyme levels, which is a marker for liver damage. You don't want the underwriter thinking you have a liver problem just because you hit the gym too hard the day before. The 24 hours leading up to the exam are critical. No alcohol. Period. It's full of sugar, it dehydrates you, and it can mess with your liver enzymes. Also, no caffeine or nicotine for at least 8 to 12 hours before the exam. Both are stimulants that will raise your blood pressure and heart rate. Finally, try to get a really good night's sleep. Being well rested will help keep your blood pressure and pulse in the optimal range. On the morning of the exam, your best bet is to schedule it first thing. Your body is in a natural resting and fasting state. You'll need to fast for at least 8 hours beforehand, meaning nothing but water. This ensures the most accurate reading of your cholesterol and glucose levels. About an hour before the examiner arrives, drink a large glass of water. This will ensure you're hydrated for the blood draw and can easily provide a urine sample. When the examiner arrives, be calm. If you're feeling stressed, take a few deep breaths before they take your blood pressure. Have your photo ID ready, along with a list of your doctor's names and addresses, and a list of any medications you're taking. Wear a short-sleeved shirt to make the blood draw easy. You've done the prep work, now just let the process happen. Once the exam is done, your file goes into the black box of underwriting. It can feel like you're sending your hopes and dreams into a void for the next 4 to 8 weeks. But here's what's actually happening behind the scenes. The underwriter, who is a real person, is now playing detective with all the pieces you've given them. They're looking at your application, the phone interview transcript, and the lab results from your medical exam. But they're also gathering more data. They will almost certainly order an attending physician statement or APS from your doctor. This is basically your entire medical file for the last 5 to 10 years. This is why you can't hide anything. The underwriter will see every note, every diagnosis, and every prescription your doctor has on file. This is often the biggest cause of delays in the process, because doctors' offices can be slow to respond to these requests. They will also pull your motor vehicle report or MVR. A history of DUIs, reckless driving, or a lot of speeding tickets makes you a higher risk. And they'll run that prescription database check I mentioned to see a full history of medications you've been prescribed. The underwriter's job is to take all of these data points, your exam, your doctor's notes, your driving record, your MIB file, and build a complete picture of your life expectancy. They then compare that picture to their company's risk charts and assign you a health class, which determines your final price. After weeks of this painstaking review, you'll finally get a decision. It could be Preferred Plus, the gold star meaning you get the best rate. It could be Standard, the rate quoted to an average person. Or it could be something else entirely. It could be a rated policy, which is a standard price plus an extra 25, 50, or 100%. Or it could be an outright denial. Most people think this decision is the end of the road. They think it's a final judgment they just have to accept. They are wrong. An underwriting decision isn't a universal law of medicine or finance. It's not a doctor's diagnosis. It is simply one company's opinion, based on their specific, proprietary, and often rigid rulebook. Think of it like this: trying to get a life insurance policy is like trying to get into college. Getting rejected from Harvard doesn't mean you can't get a fantastic education at Stanford or MIT. They all have different admissions criteria, different things they value, and different things they're willing to overlook. Insurance carriers are exactly the same. One company might be terrified of a slightly high cholesterol number, while another company is far more concerned with your family's health history. One might penalize you heavily for a speeding ticket you got 3 years ago, while another barely even considers it. The mistake 99% of people make is thinking the first no, or the first yes but it'll cost you a fortune, is the only answer they'll ever get. So what's the secret? What do you do when you get that dreaded email with a bad offer? Or an outright denial? You don't just accept it. You don't get discouraged. You take that information and you go shopping. Not for a new product but for a new underwriter. And you do it through an independent broker. This is the single most important strategic advantage you can have in this process. Let me tell you about a client we'll call David. David was 45 years old, married with 2 kids in middle school. He was a software engineer, the primary breadwinner, and he was trying to do the right thing by getting $1 million 30-year term policy. He's a pretty healthy guy, but he had a few dings on his record. He was about 20 pounds overweight, putting his BMI in the overweight category. His cholesterol was a little elevated, something his doctor said was manageable with diet. And he had a successful minor heart procedure about 10 years ago, an ablation for an arrhythmia that was completely resolved, with his cardiologist's full sign-off. David, thinking it would be easier, went directly to a big famous insurance company you see on TV all the time. He filled out the application honestly, did the medical exam, and waited. 3 weeks later he got the verdict: denied. The reason cited was the combination of his BMI and his cardiac history. David was devastated. He thought, if this huge company won't insure me, nobody will. I'm uninsurable. He was ready to give up. Fortunately, a friend told him to talk to an independent agent before throwing in the towel. This is where the game changed. The agent listened to David's whole story. He looked at the lab results from the exam David already took. He read the denial letter. And then he smiled. He told David, the company that denied you is notoriously conservative with any cardiac history, no matter how minor or how far in the past. It's their specialty to be cautious. But their rulebook isn't the only rulebook in town. The agent explained that the insurance market is a landscape of different appetites for risk. Carrier A, who denied David, is like a vegan restaurant. They see any hint of meat in your history and say no. But Carrier B might be okay with chicken, and Carrier C might be a full-blown steakhouse. You just have to find the right restaurant for your diet. So here's what the agent did. He took David's entire file, the lab results, the doctor's notes, the application data, and created an anonymous profile. No name, no social security number. Just male, age 45, non-smoker, with this specific medical history. Then he sent this anonymous profile out as a trial balloon, or an informal inquiry, to a dozen different insurance carriers that he knew from experience had more lenient underwriting for David's specific issues. This is a critical step. By doing it informally, nothing gets officially recorded in the Medical Information Bureau, or MIB. It's like asking the colleges for their admissions criteria before you actually send in your transcript and pay the application fee. The results started trickling in. As expected, 5 or 6 carriers came back with a quick no. They had similar strict guidelines to the first company. A few others came back with very expensive, rated offers, the kind of policy David got offered initially that was too expensive. But then 3 carriers came back with something amazing. One carrier, let's call them Acme Life, was known for being very competitive for people with elevated BMI. Their underwriting guide said that as long as other factors like blood pressure and cholesterol were in a reasonable range, they didn't penalize for weight as much as their competitors. They came back with a tentative offer of Standard. Another carrier, Pioneer Insurance, specialized in well-managed, distant cardiac histories. They actually had underwriters who were trained to read cardiology reports and understand the difference between a major, ongoing risk and a minor, resolved issue like David's. They came back with a tentative offer of Standard Plus. And a third carrier, Guardian Financial, didn't love the BMI or the heart history individually, but their underwriting matrix was more holistic. Because David's income was high, his family health history was clean, and his recent checkups were perfect, they were willing to balance the scales. They also offered Standard. Suddenly, David went from being uninsurable to having 3 solid, affordable offers on the table. He went from a denial to a choice. The agent advised him that the Pioneer Insurance offer was the strongest. David submitted a formal application to them. They already had all his information from the informal inquiry, so the process was incredibly fast. 2 weeks later, he had an approved $1 million 30-year term policy in his hands, at a Standard Plus rate that was well within his budget. He went from total despair to complete peace of mind, all because he didn't accept the first no. This story illustrates the most powerful lesson in buying life insurance. The first offer is not the final offer. It's just the opening bid. Your health profile is not a single, unchangeable fact. It's a collection of data points, and different companies will interpret that data in radically different ways. An independent agent is like a translator, who knows how to present your data to the company that will read it most favorably. This same principle applies even if you just get a bad rating instead of an outright denial. If you were quoted at preferred best rates but the final offer comes back at Standard, costing you 50% more, don't just sign the paperwork. An agent can and should shop that Standard offer to other carriers. Another company might look at the exact same medical file and grant you the preferred rate you were hoping for. You have leverage, but only if you know you have it. There's one more tactic you can use, called a reconsideration request. Let's say you're on the borderline. The underwriter gives you a Standard rating because your cholesterol was 225, and the cutoff for preferred was 220. You can actually go back to the insurance company and say, hold on. You then spend 2 months working on your diet and exercise, get a new blood test from your doctor showing your cholesterol is now 215, and submit that new evidence. Many underwriters will review the new information and upgrade your health class, saving you money for the next 30 years. You can do this for blood pressure, weight, and other modifiable factors. It shows the underwriter you're proactive about your health, which is exactly what they want to see. So the power is truly in your hands, far more than you think. The key is to see that first decision not as a verdict but simply as data. It's the starting point of a negotiation. Now, once you've navigated this entire process, once you've fought for the best possible offer and you have that approved policy in your possession, you might think you're done. You might think your family is protected. But there is one final crucial step that over half of all policyholders forget. And skipping it can mean that even with a valid policy, your family might not get a single penny when they need it most. That forgotten step, the one detail that can invalidate a lifetime of planning, is your beneficiary designation. Sounds simple. Almost insultingly simple. You fill out a name on a form when you first get the policy and you're done. But life isn't simple. Life is messy and it changes, and if your policy doesn't change with it, that death benefit, that financial fortress you built could crumble into dust. Let me tell you about a man we'll call David. David was a great guy. In his late 20s, he married his college sweetheart, and being a responsible young man, he bought a 30-year term life insurance policy. A big one, $1 million. He named his wife, Jessica, as the sole beneficiary. He tucked the paperwork away, and for the next decade, he paid his premiums on time every single month. But life happened. David and Jessica grew apart. They had a difficult but amicable divorce. A few years later, David met Sarah. They fell deeply in love, got married, and had 2 beautiful children. They built a life together. They bought a house, took on a mortgage, and planned for their kids' college education. David was a fantastic father and husband. He felt secure, knowing that if anything ever happened to him, his $1 million policy would take care of Sarah and the kids. Then the unthinkable happened. At age 48, David suffered a massive, unexpected heart attack and passed away. Amidst her grief, Sarah began the heartbreaking process of getting their finances in order. She found the life insurance policy, a small comfort in a storm of pain. She filed the claim, expecting the $1 million benefit that would allow her to stay in their home, to raise their children without the crushing weight of financial ruin. A few weeks later, she received a letter from the insurance company, a letter of denial. Not to her, But to the policy's listed beneficiary, the $1 million wasn't going to Sarah and her children. It was going to Jessica, David's ex-wife from 15 years ago. Because David, in all his years of responsible planning, made one catastrophic mistake. He never updated his beneficiary. Legally, the insurance company had no choice. A beneficiary designation is a legally binding contract. It supersedes a will. It supersedes marriage. It supersedes common sense. Sarah and her children, the people David loved more than anything and intended to protect, got nothing. Jessica, a woman who hadn't been a part of his life for over a decade, received a $1 million windfall. This isn't just a scary story. Variations of this happen all the time. It's one of the most common and tragic mistakes in all of personal finance. So right now we are going to fix this. We're going to build an ironclad beneficiary plan so that your money goes to the right people at the right time with no complications. First, you have two types of beneficiaries, primary and contingent. Think of it as Plan A and Plan B. Your primary beneficiary is first in line. This is typically your spouse. If you have multiple primary beneficiaries, say your children, you'll assign a percentage to each, totaling 100%. For example, you could list your spouse as 100% primary. Simple. But what if something happens to your primary beneficiary? What if you and your spouse are in a car accident together? This is where the contingent or secondary beneficiary comes in. This is Plan B. If the primary beneficiary cannot accept the payout, the money goes to the contingent beneficiaries. These are the people next in line. You could name your children, your parents, a sibling, or even a trust. Without a contingent beneficiary, if your primary is gone, the money gets paid to your estate. And that is a disaster you want to avoid at all costs. When money goes to your estate, it has to go through probate court. This is a long, expensive, and public legal process. It can take months, even years. Creditors can come after the money, and your family, who needs that cash now for the mortgage and groceries, is stuck waiting for a judge to decide how to distribute what's left. Naming a contingent beneficiary completely bypasses probate. The money goes directly to them, tax-free, usually within a few weeks. It is clean, fast, and private. Now let's talk about the single biggest trap for parents: naming minor children as beneficiaries. You might think, I'll just name my son Timmy, who's 6, as the contingent beneficiary. Do not do this. Legally, a minor cannot directly inherit a large sum of money. If you name your 6-year-old as a beneficiary and you pass away, the insurance company can't just write a check to a first grader. Instead, a court will have to step in and appoint a legal guardian to manage the money until your child turns 18 or 21. This process is expensive, it's controlled by a stranger, and the person the court appoints might not be who you would have chosen. So how do you protect your kids? You have two main options. The simplest is to set up a UTMA, which stands for the Uniform Transfers to Minors Act. You would name an adult custodian, say your trusted sister, as the custodian for your child under the UTMA. On the beneficiary form, it would look something like Jane Smith as custodian for Timmy Smith, under your state's Uniform Transfers to Minors Act. This way, the money goes to your sister, who is legally obligated to use it for your son's benefit, and he gets full control at the age of majority. The more robust and often better solution is to create a living trust. You name the trust as the beneficiary of your life insurance policy. In the trust document, you lay out your exact instructions: who manages the money, the trustee, and how and when your children get it. You can specify that it be used for education, a down payment on a house, or you can even stagger the payouts, like 1/3 at age 25, 1/3 at 30, and the rest at 35. A trust gives you ultimate control from beyond the grave and protects a young adult from inheriting a huge sum of money before they're mature enough to handle it. Now for a pro tip that your insurance agent might not even mention. It's about two little Latin words: per stirpes. When you're naming your children as beneficiaries, you might see a little checkbox that says, per stirpes. Check that box. Here's why. Let's say you have two children, Emily and Ben, and you list them as 50-50 beneficiaries. Tragically, Ben passes away before you do, but he leaves behind two children of his own, your grandchildren. If you die, what happens? Without the per stirpes designation, 100% of the money would go to your surviving child, Emily. Ben's children, your grandchildren, would get nothing. That's the default, called per capita. But if you checked per stirpes, which means by the branch, something different happens. Emily still gets her 50%, but Ben's 50% share would pass down his branch of the family tree directly to his children. Your grandchildren would split his share. This ensures that no branch of your family is ever accidentally disinherited. It's a small detail with massive implications. So here is your action plan. Not tomorrow, not next week. Today. 1. Log into your life insurance online portal, or pull out the physical policy documents. 2. Check your primary beneficiary. Is it the right person? Is their name spelled correctly? Is their social security number listed and accurate? Don't write "my wife." Use their full legal name, Sarah Jane Smith. Be specific. 3. Check your contingent beneficiary. Do you have one? If not, add one right now. If you do, is it still the right person or entity? 4. If you have minor children, ensure you have a proper structure in place, either a UTMA designation or ideally a trust. Do not name them directly. 5. Look for that per stirpes option and select it. You went on a journey. You learned what 30-year term life insurance is, and why it's the financial cornerstone for most American families. You figured out how much coverage you need to make your family whole. You learned how to get quotes, how to navigate the application and the medical exam, and how to get the absolute best rate possible. And now you've learned the final critical piece of the puzzle, ensuring that protection actually lands in the hands of the people you love. You've done the hard work. You've faced your own mortality, not with fear, but with responsibility. You've taken a complex subject and you've mastered it. This policy isn't just a piece of paper. It's a promise. It's the roof over your family's head. It's the college education for your children. It's the peace of mind for your spouse during the worst time of their life. It is the ultimate expression of love and foresight. It's you continuing to provide for them, even when you're no longer there to do it in person. Protect that promise. Check your beneficiaries today.